NIO stock closed Thursday at $6.24, down about 3.3%. The market was sharply lower, tech and growth stocks were hammered across the board, and once again NIO was swept up in the broader wave of selling. On the surface, that's the entire story. Another down day, another session where the market mood dictated price more than the company's performance. But when you look a little deeper, what stands out most isn't what changed, it's what didn't. Because once again, there was no major negative news about NIO. No earnings warning, no guidance cut, no analyst downgrade, no delivery miss, no regulatory setback. The fundamentals remain the same as they were a week ago. Yet the stock is down, following a familiar pattern we've seen for most of this month. Steady operational progress overshadowed by macro-driven volatility. So let's unpack what really happened today, why the stock fell, and what this might mean for investors heading into the weekend. To start with the context, markets were ugly today. The Nasdaq dropped hard, weighed down by weakness in mega-cap tech stocks. Treasury yields climbed again, oil prices slipped, and investor sentiment tilted back toward risk-off mode. When that happens, names like NIO are almost always the first to feel it. The company trades as a high beta stock, meaning its movements are amplified versions of what the broader market does. So when the Nasdaq slides 1%, NIO often drops 3%. And that's almost exactly what happened today. But this wasn't a case of NIO-specific panic. If you look across the Chinese ADR landscape, the same story played out. XPeng fell. Li Auto fell. Alibaba and JD.com were both down. It was a sector-wide move driven by caution around Chinese names, growth valuations, and global macro tension. Every time the market takes a defensive tone, this entire basket of stocks gets hit, even when the companies themselves are doing fine operationally. So the question becomes, was there anything under the surface that might have contributed to the weakness beyond macro forces? The short answer is, not really. NIO hasn't released any new filings, hasn't made any material disclosures, and hasn't faced any negative headlines since earlier in the week. The most recent pieces of news are actually neutral to positive. Just a few days ago, The Motley Fool ran an article highlighting how NIO's growth strategy is impressive but may not deliver rapid shareholder gains until 2026. And while the tone of that analysis was cautious, it wasn't a downgrade or a hit piece, it was more about valuation and patience than any fundamental red flag. The other ongoing narrative is simply anticipation around NIO's upcoming third-quarter earnings, which are scheduled for November 25th. That's now less than 2 weeks away. Traders know that's going to be a major event for the stock, and it's not uncommon for short-term money to pull back ahead of big reports, especially when the market is already showing signs of fatigue. So what we saw today was not panic, it was positioning. Investors stepping back, letting the market settle, and likely waiting for clarity from earnings before taking fresh positions. If you look at NIO's chart over the last few weeks, it's actually been consolidating in a fairly tight range. We've seen the stock bounce between $6 and $6.80 repeatedly. Each time it tries to move higher, sellers show up around the upper end of that range. And each time it approaches support in the low $6 zone, buyers step in. That kind of range-bound behavior is typical for a stock that's waiting for a catalyst. It's neither being bid up on hype nor collapsing on fear, it's drifting in neutral. Today's drop just brought it toward the bottom of that range again. But here's what's really interesting. While the price moves day to day, the underlying data points keep improving quietly in the background. NIO just reported record deliveries in October, over 40,000 vehicles, up more than 90% year over year. The company also shipped 431 vehicles overseas in October, one of its biggest export months ever. And production on the ES8 line is ramping up significantly, with a 70% increase in capacity this month. All of these are strong operational signals. They show growth, execution, and expansion. And yet, because we're in a market dominated by sentiment and short-term trading, those achievements are being drowned out by macro noise. So, as an investor or trader, how do you interpret that? The answer depends on your time frame. If you're a short-term trader, the technicals are probably what you're watching most closely. Right now, NIO's next key support sits around $6 even. If that level breaks on heavy volume, you could see a quick flush lower toward $5.80. But if it holds, and there's a good chance it does, given previous buying interest there, you might see a rebound next week as traders start speculating on earnings. Short-term moves around these levels tend to be sentiment-driven rather than fundamentally driven, so watching volume and intraday flow matters more than any single headline. If you're a long-term investor, today's decline doesn't change the bigger picture at all. The company continues to deliver vehicles at record levels. It continues to expand its brand portfolio with Firefly and Onvo. It's growing its European presence. And it's doing all of this while the global macro environment remains uncertain and investor appetite for Chinese stocks remains low. That's not a reflection of company failure, that's a reflection of timing. The long-term story for NIO has always been about three things: product differentiation, technological infrastructure, and international expansion. On all three fronts, the company is moving forward. The Firefly launch marks the company's next phase of global growth, focused on compact EVs for the European market. The battery swap network continues to expand, reinforcing NIO's position as a tech-integrated automaker rather than a traditional car manufacturer. And the pace of deliveries shows that domestic demand remains solid even in a highly competitive Chinese EV market. So, the real angle for your after-hours video tonight is this: today's drop was about sentiment, not substance. The market punished tech broadly, Chinese ADRs got caught in the downdraft, and NIO stock was simply collateral damage. There's no new negative news, no internal disruption, and no reason to assume today's red candle signals anything deeper. The fundamentals are steady. The catalysts are approaching. The story remains intact. The headline for your video could be something like, NIO down 3.3%, sentiment drag, not a delivery disaster. It captures the essence of what happened without overstating it. You can lead with the fact that NIO fell more than 3% in a market where everything was red. Emphasize that while the price moved lower, the story hasn't changed. And explain that this type of action is common in periods leading up to earnings, especially when the broader market is nervous. From there, pivot into what viewers should watch next. The first big milestone is the Q3 earnings report on November 25th. That's when investors will finally see how much of the recent delivery strength has translated into revenue and margin improvement. The second is the November delivery update, another chance for NIO to reinforce its growth trend. And finally, any fresh commentary on export growth or production efficiency could be key in changing sentiment. As you wrap up, remind your viewers that volatility like this is not unusual for NIO. The stock has been through multiple cycles of pessimism and optimism, often swinging in double digits without major news. What matters more than the day-to-day noise is whether the company continues to execute, and right now, it is. So, while today's drop might look discouraging on the chart, the real story is one of patience. The market may not be rewarding progress now, but progress is still happening. And for investors who can look beyond a few red days, that distinction is everything. If you found this analysis helpful, make sure to like the video, subscribe for more NIO and EV market coverage, and let me know in the comments. Do you think NIO is being unfairly dragged down with the rest of tech, or do you see this as a warning sign ahead of earnings? Either way, I'll break it all down for you again in the next video.